Hello, my name is Nicole, and this video is about the synthetic long call strategy. If you want to trade options like a pro, you need to think in terms of synthetic relationships. This strategy, the synthetic long call, otherwise known as the married put, is more than just a trade idea. It's a mental model that will sharpen how you see the market. Topics covered in this video include a definition of the synthetic long call strategy. We're going to demonstrate how the strategy works and talk about the risk-reward profile, including max gain, max loss, and break-evens. We're going to go through the advantages and disadvantages of the strategy, and finally we're going to talk about some of the best use cases for the synthetic long call strategy. So what is a synthetic long call? A synthetic long call is a position that mimics the payoff of a long call option. This strategy is also known as a married put. Here's how it works. When you buy stock, you simultaneously buy a put for the same number of shares that you are long stock. And after you've done that, you've essentially created a call synthetically. So let's hop into the tastytrade platform to demonstrate what we just discussed. And you can see here I have SPY populated in the trade tab. Let's bring up the tasty charts to take a look at what's been going on in SPY. You can see here that early in the year we had some weakness followed by a strong rebound. And for the sake of this example, we're going to assume that I'm cautiously optimistic that SPY will continue to be strong into the end of the year. And we're going to note that implied volatility is relatively low with an IV rank of 13.2. Now for this example, let's assume I want to buy 100 shares, but I want put protection through the end of the third quarter. We can see that in the September 30th, 2025 quarterly expiration, implied volatility is at about 18.5%. And I'm going to populate buying 100 shares at the market price, as well as buying an at-the-money put. And we can see here that the overall position delta would be positive by 50.92. And if I were to put this trade on, I would see $32,706.50 reduced in my buying power. Highlighting here the P&L graph, we can see here that at expiration, my profit would be unlimited to the upside, and my downside risk would be limited to $1,493. Now let's contrast that with purchasing a long call option. I'm going to go to the same expiration. I'm going to repopulate the synthetic long call position that we just had on because we're going to match up the Greeks here. So we can see here that that would give us a positive delta of 50.91, a negative theta of 9.949. And lo and behold, if we were to replicate that position with a call, we'd be buying the same strike as what we'd be buying for a put. So in order to achieve a positive delta of 0.51, we'd be buying the 624 strike call option. And that would only reduce our buying power by $1,922. So big difference between that and doing the synthetic long call position. And bringing up the profit and loss diagram, you can see that they're nearly identical. We have unlimited profit to the upside with limited loss to the downside. Now let's go back to the trade table here. And I want to see what would happen if we bought a protective put further out of the money. And what call would we need to purchase in order to replicate that trade to make it synthetically the same? So if I bought 100 shares at the market and I decide I only needed protection at the 610 strike and below, that position would give us positive delta of 63.78. And again, our buying power effect would be significant. It'd be reduced by a little over $32,000. And if I bring up the P&L graph here, we're going to notice profit again is unlimited to the upside, and loss is limited to the downside, this time to the tune of $2,487. Now let's compare that to buying a long call. So I'm going to repopulate that position. We're going to remember that the positive delta was 63.75, and if I want to replicate that, we're going to see that I would have to purchase the 610 call. So kind of interesting. It would be the same strike price as the protective put. So if I populated that, that would give us a delta of 61.7. Our buying power would be reduced by $2,927, which is the cost of the call. And once again, unlimited profit to the upside with limited loss. Now let's talk about break even and profit and loss. Break even is simple to calculate. You take the stock purchase price and add the put premium price to get your break even value. Max profit is unlimited with dollar for dollar gains above break even, and max loss is calculated by taking the stock price minus the put price multiplied times 100. You take that value and you add it to the put premium. Now let's compare the Greeks between the synthetic long call versus the simple long call. So in the top image here, I have a screenshot taken from the thinkorswim trading platform with the long 610 call populated. And the bottom image is the same screenshot taken with the synthetic long call position where we purchased 100 shares of SPY while simultaneously buying 1610 put. Comparing the Greeks, we see that they both have a positive delta of about 66. The gammas are very similar with 0.75 for the long call and 0.77 for the synthetic long call. We have a negative 14.93 theta for the long call and a negative 9.60 value for theta with the synthetic. And the vegas are the same, coming in at 104. Now let's talk about some of the advantages of the synthetic long call as a standalone position. It has defined downside risk. The long put limits your losses. Just like the long call, you know your max risk up front. It has unlimited upside potential. So just like the long call, you benefit fully from a strong rally. And you get the benefits of stock ownership. You get dividends and voting rights if that's important to you. And it has positive vega exposure. So similar to the long call, the long put gains value when implied volatility rises, which often happens when markets sell off. So what are the main disadvantages to the synthetic long call? Well, the primary disadvantage is the high capital requirement necessary to put this trade on. You're buying stock outright, which is not a cheap trade. Next, theta decay. Like the long call, the long put loses value over time, and the decay can sometimes be more pronounced for the synthetic position. And finally, complexity. You're managing two instruments instead of one. Now let's talk about when to use synthetic long calls. And there aren't that many situations in which it makes sense. It can make sense for assets where implied volatility tends to rise with price, such as meme stocks and commodities. And if you're going to use this strategy with those assets, you want to make sure implied volatility is low, where the long put option will trade relatively cheap. So here are my final thoughts and summary. While the synthetic long call is an interesting concept, it's not always a practical strategy. The biggest drawback is its high capital requirements. When compared to a simple long call, it ties up far more capital without any difference in performance. But here's the thing, working through this structure makes you a better trader. Understanding how stock, puts, and calls interact synthetically helps you to recognize better opportunities. So the next time you're thinking about adding a protective put to a short-term stock position, pause and remember this video and be sure to ask yourself, would I be better off just exiting the stock and buying a long call instead? The synthetic long call is the second of 6 essential synthetic positions that every options trader should understand. In the next video, we'll dive into the synthetic long put and discover when creating put exposure using stock and calls might give you advantages over simply buying put options. The power of understanding synthetics is that it deepens your understanding of derivatives and can multiply your strategic options. Instead of being limited to one way of expressing your market view, you can choose the trade structure that best matches your capital situation, time horizon, and market conditions. If this breakdown of the synthetic long call was helpful, make sure to subscribe and hit the notification bell so you don't miss the rest of the series. Thanks for watching, and I'll see you in the next video. And as always, be awesome.